Hey traders, wow, what a great week trading this week. My total was 5,638 for the week. So it's probably one of my best weeks that I've ever had. I thought it was going to be tough to beat the $4,000 week that I had several weeks ago, but this week was just a great week. Now, granted, about 1,500 of that came from this WDC trade that I've been rolling, because as I mentioned before, I don't account for my profits on the rolls until I actually finish rolling. So really, about 1,500 of that occurred over several weeks. I didn't close it out until this week. So really, if you want to just account for this specific week, I had a credit of 470, and then I closed this out for 8. But from a spreadsheet tracking standpoint, I have not accounted for all of the profits for these rolls. So that's why I included in this amount. So you can either call this 5,600, or if you want to take those out, you can say it was a $4,000 week. Either way, it's still a great week. Shoot me an email and let me know how your trades went. I always like to hear how you guys are doing as well, even if I don't get a chance to always reply to your emails. Before we get started with the recap, I just want to say to stick around to the end of the video. I have some information to share with you guys that I thought was pretty interesting. Okay, so if we go back to my email from last Friday, you can see here are the trade alerts that I sent out. So I submitted 3 new trades last week for Micron, Twitter, and Chewy, and then there was the roll trade for WDC. So going back to the spreadsheet, you can see I have the first trade there is the Chewy trade. I was in this trade for the entire week. I had sold the 45.50 strike for this week, collected a 51-cent credit, and was able to close it for 2 cents today. If you remember yesterday, I put in the newsletter, I was trying to close this out yesterday for around 7 or 8 cents, but it never filled. And then today I was actually able to close it out a lot cheaper. So got a nice total profit on that one for $490. The Twitter trade that I put on, Twitter had some news come out a couple days ago about a hack that affected a lot of high-profile Twitter accounts. And luckily, when it opened the next day, the stock was above my strike price. It had actually dipped down to the strike price after hours when the news came out. And luckily, it opened up still above my strike price. And I went ahead and closed it out for 29 cents. I don't normally close it out for that much, but I just didn't want to risk more bad news coming out or something else happening to cause Twitter to tank. I just wanted to be out of it and be done with it. So I got a small profit of 170 on that one. MU was another good trade. I sold the 48 strike. I was able to get out of it after 4 days. Initial credit 50 cents, closed it for 7 cents, total profit $430. That was all the trades that I had put on Friday. And then this week I put on another trade in Tesla. I had done this same trade last week. The premiums were so high in Tesla, and I was able to sell the 2,500 call. It was like the highest strike price that was available for Tesla, and get a $15 credit. That's $1,500 for one contract, and I could only afford to do one contract because of the margin requirement. I was able to close it out same day, so about 6 hours later, I was able to close it out for 4.15, giving me a total profit of $1,085. So that was a really great trade. The next one I put on this week was a credit spread in Amazon. Amazon had dropped a few days in a row, and I was able to get my strike prices about 100 points away from where Amazon was trading at the time. So I just thought it was a good opportunity to put a trade on Amazon. It did get close to testing my strikes, but eventually, it was above them significantly enough for me to close it out for the majority of the profit. So I'd sold the 2,900, 28.95 put credit spread. Initially got a credit of $1.02, and I closed for 5 cents, profit of $485. You can see also, typically right around $400 to $500 is what I try to capture profit-wise. So if the credit is going to be, say, $1, I do fewer contracts. So my typical contract size is 10. For Tesla, I only did 1, again, because I could only afford to do 1. But for the spreads, I did 5 because I was getting $1 credit. In this case, if I'd have done 10 contracts, I'd have been risking about $4,000. I didn't want to have that big of a risk, so I did just the 5 contracts. The next 2 are Netflix. So Netflix had earnings that came out yesterday. This was a pure earnings play. Initially, I put on this 475, 470 put spread, received $1.05 credit. And so in this case, I needed Netflix to stay above 475 after the earnings announcement. This was just a one-day expiration. I put this on yesterday to expire today. Even though Netflix did take a pretty big hit, it stayed above my strike prices. I was able to close it out. I put an order in this morning. I sent this out in the trade alerts this morning when I closed it. I was pretty busy at work this morning with a lot of meetings. Wouldn't have time to watch the market open to see how Netflix was trading. So I just went ahead and put a limit order in to close it at 0.5. And it filled pretty much immediately when the market opened. So I probably could have got a better price if I'd have had the time to really negotiate my price. I would have probably put it in for a lot less and then gradually increased it until I got the fill. But I'm happy I was able to get out of this still at a profit of 275. It could have been a lot worse if Netflix would have dropped more. And that's another reason why I put that limit order in. I didn't want to risk it dropping throughout the day and me not being able to watch it because of meetings I had going on with work. The next one was, so yesterday after I put on that put credit spread, Netflix started going up a good bit. So I thought that would be a good opportunity to sell a call. So I sold the 650 strike price, which was a good strike price because I think the expected move for Netflix was 50 and the stock was trading right around 530 or so when I put this on. So I mean, it was over double the expected move this would have had to have gone to hit this strike price. And I got a nice credit of 2.55. Again, I only put on 2 contracts because I just wanted to get my usual 500. And since Netflix dropped this morning, I was able to close it out for a penny. Interesting fact, these 2 trades combined, so if you put on a put credit spread and sell a naked call at the same time, again, I did these as separate trades, but once you have these 2 trades on, it's called a twisted sister. Now, you won't see that name in your brokerage account. It's not an official term for this strategy. But if we go look up on Wikipedia, you can see right here under Twisted Sister, it says, the construction of a twisted sister consists of a bull vertical spread. So that put credit spread that I had on is a bull vertical spread, or it's also referred to as a bull put spread, created with put options along with the sale of a call option. So that's when I sold the naked call. For one underlying security, a put option is sold at one strike price and another put option is bought at a lower strike price. Then an out-of-the-money call option is sold at a strike price higher than that of both put options. So just thought it'd be interesting for you guys to know there's actually a name for that. Jade Lizard is the more popular name. It's the reverse of a twisted sister. It would be where you did a bear call vertical spread. So you would sell a call spread and then you would sell a naked put. And you can see these terms, again, I said are not official terms. They were first used by Liz and Jenny on the Liz and Jenny show. If you guys are familiar with tastytrade, they have a segment on there, and their hosts are Liz and Jenny. And at some point years ago, they came up with these terms for these 2 strategies. The other trade I had this week was in Etsy. This was a very quick trade. I got in it on 7/16, and once I got in, Etsy, went up a little bit, so I was able to close it out 3 hours later. I got an initial credit of $1.11, and I closed it for 0.4. Total profit of 355. Again, for this, I only did 5 contracts. I get a lot of questions. Probably the question I get the most in email is asking me how I pick my stocks or how I pick my strike prices. And that's still a video that I'm going to make at some point. But I'll show you this one just to give you an example of some things that I may look at when I'm trying to decide if I want to get into a stock or not. So here's a chart in Etsy. And I look at charts a good bit in the evenings. I'll just go through my watch list looking at charts. And this was one that I just happened to have looked at the night before. And I noticed that for a couple days, Etsy went down to the 100 price level. And the bulls pushed it back up to where it closed near the open for this day. This is considered a doji candle. And you can see the day after that, the same thing happened. The bears tried to push it down below 100 again, but the bulls pushed it back up for it to close where it opened, and we had another doji candle. Also, you can see a few weeks ago, there was some consolidation around the 100 price level. So since I saw this the night before, on Thursday, when I was looking to put on a new trade, after I had closed out my Micron and Twitter, I saw that it was near the 100 price level again. I think it was trading around 101. So I was just thinking that, we'd probably have another day similar to the past 2 days where the bulls would push it back up to close above this level. And sure enough, shortly after I got in, just a few hours later, the stock started going back up, and it got up to around 103, and that's why I was able to go ahead and close it out. and there was no need to hold it for another day, which if I would have, I'd have still been okay. I could have closed it out today and realized the full profit. So that just gives you an example of some of the things I consider when I'm looking at a stock or looking at what level I want to get into a stock. Last two, WDC, I talked about it earlier. This is one I've been rolling several weeks. Technically, last week I did not need to roll it, as I'd mentioned in the last video, but I went ahead and rolled it just to go ahead and capture some more credit because I was going to put on a trade with them anyhow. So after all the rolls and my initial credit, that turned out to be an $1,800 profit over 29 days. Again, that's 29 trading days. GEOS, I rolled it earlier in the week. I rolled it out 2 weeks because I want to be able to roll it down a strike price and still get a credit. So I rolled it 2 weeks down to the 24 and I got a credit of 1 cent. This is one that, it's not moving the way I hoped it would. It did jump up to 24, I believe it was yesterday, but it's back down around 22 something. So again, I'll just keep rolling this in 2 week chunks to keep lowering the strike price. So it may take another month or so to hopefully get out of this one and be done having to roll it. So I mentioned in the beginning of the video, there was something I wanted to show you guys. First, let me pull up the trade alert I sent out earlier today. So here are the new trades I put on today. You can see I put a trade on an Etsy, Micron, Chewy, basically same ones I've been trading. And I put on a trade in Citi again, and you can see that I picked the at the money strike for this one, which I don't normally do. Normally I pick a strike price that's roughly around the 75% probability by the money. And I said I'll talk about this in the recap. So this is what I want to show you guys. So I mentioned tastytrade earlier. I'm sure all you guys are familiar with tastytrade. If you search on YouTube anything to do with options, their videos are going to come up. When I was doing the What's the Risk video that I put out a few weeks ago, I had remembered that tastytrade did a segment. I don't remember when it was probably 4 or 5 years ago. And they were talking about the 2008 crash. They were showing various buying power percentages and how your portfolio would have performed during that 2008 crash. So the What's the Risk video that I was making was a similar video. I was trying to show you guys how much you would potentially lose using various percentages of your buying power. So I was curious to see what they had said in their video about 2008. If I remember correctly, it was around 25% or 30% of your buying power. If you'd have been using that amount, you'd have been safe during the 2008 crash, meaning that you would not have been in a margin call if you'd have been using 30% or less of your buying power. So I was trying to find that video to see what that specific number was so that I could mention it in my video. And I never did find the video. I couldn't find it anymore. I don't know if they took it down. Maybe one of you guys can find it and shoot it over to me. So anyway, in the process of looking for that video, I stumbled across this one. I was watching several different videos trying to see if it was the one. And this one was talking about buying power risk. And what I found interesting in this video, and I'll include it in the link because I want to give credit where credit's due. This wasn't my idea. This was an idea that I got from this video. And it helped spark me to put on my Citi trade the way that I did. But essentially what they're talking about in this video is as your account grows, should you increase the contract size or should you choose a strike price closer to the stock? So for example, let's say you have a $10,000 account and you typically trade 1 or 2 contracts for each of your positions. Well, once your account gets to $20,000, you would think it makes logical sense for you to, instead of just doing 1 contract, now start doing 2 contracts per position. Or if you're already doing 2, maybe you're doing 4 contracts per position. But your contract size should increase as your account grows. I mean, that makes logical sense. That's what I typically do. As my account has grown, I'm increasing my contract size. But what this video showed here is that actually, as your account starts growing, it makes more sense for you to do the same amount of contracts, but choose a higher delta. We'll look at that in a second, but basically it just means choose a strike price that's closer to the stock than what you would typically choose. If you'd normally choose a strike price that's 75, 80% probability of the money, now you're choosing a strike price that's, say, 50% probability of the money. And in their study, what they did, they looked at, I believe this was for SPY. Let me maximize this. So they were looking at a 10 delta and a 50 delta. 10 delta is the same as 90% probability of the money. 50 delta is the same as 50% probability of the money. You can see in both instances it had the same buying power reduction, so the same amount of margin requirement. But the BP extension was a lot more in the 10 delta than the 50 delta. And they did this on a drop back in 2008. So one of the big drops back in the 2008 crash, this is the day they did this analysis. And the buying power expanded 3.5 times on that particular trade, the 10 delta trade, versus the 50 delta trade only expanded 2 times. So what does that mean? It means that if you had a trade on that you had sold a put at the 90% probability of the money, and let's say initially it required you to put up 10,000 margin, it reduced your buying power by $10,000. Well, that day when the market dropped, your buying power reduction would have jumped by 3.5 times. So that means your $10,000 buying power reduction would now go up to $35,000. Whereas if you'd have done the 50 delta, so your initial buying power reduction would have been $10,000 as well, but it would only have expanded to $20,000 on that initial drop. So I found this really interesting. I'd never really considered using less contracts and choosing a strike price that's closer to the stock. They talk about this in regards to as your account grows, but in my mind, why do I have to wait till my account grows? Why wouldn't I want to go look at doing that now? Instead of doing my typical 10 contracts, maybe I'll look to do 5 contracts instead. So that's what prompted me to do this trade. I sold the 50.5 strike, which was at the money, because the stock was barely above that at the time. And I only did 5 contracts, where typically I do 10 contracts, and I received a credit of $1.01. And to have the margin requirement as being $540 per contract, I'm so used to doing 10 contracts, I calculated that based off 10 contracts. But for 5 contracts, actually, it was about $1,100 per contract. So I put together a little spreadsheet to show you guys just what this looks like. It's pretty interesting. So you can see for Citigroup, I did the 50.5 strike. Right now, it's a delta of 0.52. When I did it, it was probably more like a delta of 0.5. If I would have done my typical strike that I do, which is around 75% probability of the money, I would have done the 48.5 strike, which is a delta of 0.27. The credit for the 50.5 strike was $1.01. The credit for the 48.5 strike would have been 52 cents. Look at this. This is what's interesting. The margin requirement for the 50.5 strike was 5,600 versus it would require me to put up 8,200 to do my typical 10 contracts of the 48.50 strike. So you can see I have the 5 contracts for this one, 10 for this one, and the credit's basically the same. The 48.50 was just slightly higher, but they're roughly the same credit. So now let's take a look at this. I've got the 50.5 strike and I have the 48.5 strike, and I want to look to see what happens as the stock drops. And you can see that with a 9% drop in the stock, if the stock would have dropped to 46, on the 50.5 strike, I'd be down $2,250. That's how much I would lose if I were to close it out. But on the 48.5 strike, I would actually be down $2,500. So I would lose $250 more by selling 10 contracts of the 48.50 strike versus the 5 contracts of the 50.5. Now look at this when we get down to, say, a 21% drop. You can see it gets to be a bigger difference. I would lose $3,000 more on a 21% drop if I had done my typical 48.5 strike versus the 50.5 at the money strike. And then when we get down, it just keeps getting worse. If we get down to a really big drop, like a 41% drop, it's almost double. I would lose $10,000 on the at the money strike, and I would lose $18,500 on my typical strike that I trade. So this is pretty eye-opening. I mean, it's not something that I'll probably do for all my positions, but I think it's something I'll start looking at, especially as the market keeps getting higher, because where this really benefits you is if we have a significant drop, again, like we had in March. If we knew that the market was going to relatively stay flat and go up, then it'd still be better to do the typical 48.5 strike, because the downside to doing the at the money strike means you're going to be rolling a lot more as well, right? I mean, let's say that if the stock dropped to 49 next week, I'm going to have to be rolling this. But if I'd have done my 48.5 strike, I'd have been totally fine, can close it out, and then put on the trade again for the next week at an even lower strike price and get another credit. Whereas at this strike price, I may have to roll it next week if that happens, and I'm not going to get as good of a credit. So if we knew that the market wasn't going to take a big dip, it still would make more sense to use the strike price I would typically use. But if we're looking at buying power protection, and that's really what that video is showing, is that when you have these significant moves, that your buying power expansion is going to be a lot greater on those positions where you were doing a really far out of the money strike price versus just choosing the at the money strike price. So I'll probably start looking to do a mix of these type of trades where I'll stick with my normal 10 contracts at my typical strike price level, and maybe throw 1 or 2 of them in at the money strike, just to kind of give myself some variety. And again, as the market keeps going up, if I feel like I'm in a situation where, I don't really want to have a lot of naked puts on and worrying about a drop, at least this gives me an option to still kind of be in the game selling puts and use smaller contract sizes so that if we do have a big drop, it's not going to hurt as bad. And what I want to do is go back and use my spreadsheet that I used for What's the Risk video, just to see what this would look like if those positions I would have used half the contract size for the at the money strike, to see what the impact would have been for, you know, the kind of drops we saw back in March. And then I also mentioned in that What's the Risk video, I want to run some back testing through the Thinkorswim on demand. I have played around with that some, and I still have a video to make for that to show you guys some of the back testing that I've done. But I want to run through that again and use it for these smaller contract sizes just to see what would have happened during the March crash as well. Anyway, I hope you guys found this useful. I really did when I came across that video. And also, you know, Tasty Trade's got a lot of good content out there. I don't typically watch them anymore as much as I did a few years ago because I don't really follow their strategy. They're more about selling strangles, and they go out 45 days. And as you guys know, I typically do 7 days. A lot of their videos that I used to watch a few years ago really help kind of mold and fine tune my current strategy. So I definitely have to give them credit for that. And like I said, there's a ton of content out there. If you go out to their site, and if you click the magnifying glass, you can search pretty much any topic you want to. You know, if you want to search on buying power, you scroll down, you'll get a whole bunch of videos on that topic, whatever topic you're looking for. So that's kind of what I was doing when I was trying to find that particular video I was looking for. That's all I got. I hope you guys have a great weekend.